Before we dive in, don't forget to like, subscribe, hit the notification bell, share this video, and check the links in the description for more resources. Want to build real wealth without gambling on meme stocks or chasing hype? Then keep watching, because today I'm giving you 10 proven long-term investing strategies that actually work and have helped ordinary investors retire rich. The truth is, building a 7-figure portfolio isn't about finding the next 10-bagger overnight or timing the market perfectly. It's about discipline, patience, and following a set of rules that have stood the test of time. It's about understanding that slow and steady not only wins the race, but it's the only race that truly matters when it comes to your financial future. These aren't secrets. They are fundamental principles that Wall Street pros and everyday millionaires have used for decades. Let's be honest, the financial world can feel incredibly overwhelming, with so-called gurus on every corner promising you instant riches with some secret algorithm or high-risk day trading tactic. But what they don't tell you is the sheer amount of risk involved and the high probability of losing everything. We're going to cut through all of that noise. The strategies we're covering today are designed to minimize your risk while maximizing your long-term growth potential. This isn't about getting lucky. It's about making smart, informed decisions consistently over a long period. This is the blueprint that gives you control over your financial destiny without the stomach-churning volatility of speculative bets. The goal here is simple: to empower you with the knowledge to invest with confidence so you can stop worrying about every market fluctuation and start focusing on your long-term goals. Whether you want to retire early, buy your dream home, or simply achieve financial independence, the path is paved with the strategies we're about to break down. You don't need a finance degree or a 6-figure salary to start. What you do need is a plan, and that's exactly what I'm giving you today. We're going to go step by step through each of these 10 pillars of sound investing, making it easy to understand and apply. So get ready to take some notes, because this isn't just another video. This is a comprehensive guide to building lasting wealth. We're going to cover everything from how to pick the right investments to how to manage them over time, all while keeping your emotions in check and your fees as low as possible. By the end of this video, you won't just know what to do, you'll understand why you're doing it. This is the foundation you've been looking for, the one that will help you tune out the hype and focus on what actually works. Let's get started. First up on our list is perhaps the most famous and time-tested strategy of all: buy and hold. The concept is deceptively simple. You identify great high-quality companies, you purchase their stock, and then you hold on for the long ride. We're talking years or even decades. The entire philosophy hinges on the idea that good businesses, the ones with solid fundamentals, strong leadership, and a durable product or service, will inevitably grow in value over time. The market will have its ups and downs. News headlines will scream panic, but a truly great company will weather those storms and continue to innovate, expand, and generate profits, ultimately driving its stock price higher. The key here is to ignore the noise. It's so easy to get caught up in the daily chatter of the market, the talking heads on TV, the endless stream of articles predicting the next crash, or the hype around a hot new stock. But successful buy and hold investors understand that this is all just short-term distraction. They do their research up front to find companies they truly believe in, and once they invest, they let time do the heavy lifting. This strategy requires a mindset shift from that of a trader who tries to profit from short-term price movements to that of a business owner who is invested in the long-term success of the enterprise. Think about some of the biggest and most successful companies in the world today, names like Apple, Microsoft, or Amazon. Investors who bought shares in these companies 10 or 20 years ago and simply held on have seen their initial investments grow exponentially. They didn't sell when the stock dipped 10% or when a negative news story broke. They had conviction in the company's long-term vision and its ability to execute. This is the essence of buy and hold. Having the patience and the discipline to see your investment thesis play out over a multi-year horizon, allowing the power of compounding to work its magic on your portfolio. Of course, this doesn't mean you buy any random stock and just forget about it. The first part of the strategy, buy quality, is absolutely crucial. This involves doing your due diligence. You need to look for companies with a strong competitive advantage, a history of consistent earnings growth, a healthy balance sheet with manageable debt, and a visionary management team. You are not buying a lottery ticket, you are buying a piece of a robust, well-run business. Once you've identified these high-quality assets, the hold part becomes much easier because your investment is based on solid fundamentals, not fleeting market sentiment. One of the most powerful adages in investing, and one that perfectly encapsulates the buy and hold strategy, is this: time in the market beats timing the market. So many investors, especially beginners, fall into the trap of trying to perfectly time their entries and exits. They wait for the perfect moment to buy, hoping to catch the absolute bottom, and then they try to sell at the absolute peak. The reality is this is practically impossible to do consistently. Even the most seasoned Wall Street professionals with access to immense resources and data can't reliably predict short-term market movements. Trying to do so is often a recipe for disaster. When you attempt to time the market, you introduce two major risks. First, the risk of being wrong, which is incredibly high. You might sell out of fear, only to watch the market rebound sharply without you, or you might wait on the sidelines with cash, missing out on significant gains while you wait for a dip that never comes. The data shows that the market's best days often happen in close proximity to its worst days. If you're out of the market for just a handful of those best days, your long-term returns can be dramatically reduced. It's a game where the odds are heavily stacked against you. The second risk of market timing is emotional decision-making. Trying to predict the market's next move forces you to react to fear and greed, the two emotions that are the enemies of a successful investor. You end up buying high during periods of euphoria because of a fear of missing out, and selling low during periods of panic because you're afraid of further losses. This is the exact opposite of what you should be doing. The buy and hold strategy removes this emotional turmoil from the equation. By committing to holding your investments for the long term, you're no longer reacting to the daily news cycle. You're trusting in your initial research and the long-term growth trajectory of the economy. Ultimately, the buy and hold approach allows you to harness the full power of economic growth and corporate earnings over time. You participate in the market's long, steady climb upwards, rather than trying to jump on and off a speeding train. It's a strategy that rewards patience and discipline over frantic activity. By focusing on quality and giving your investments the time they need to grow, you sidestep the fool's errand of market timing and position yourself for a much higher probability of success. So if trying to time the perfect moment to buy is a losing game, what's the alternative? This brings us to our second powerful strategy, dollar cost averaging, or DCA. This is the perfect solution for anyone who gets paralyzed by the question, is now a good time to invest? With DCA, you don't worry about that question at all. The strategy is incredibly straightforward. You invest a fixed amount of money into a particular investment at regular intervals, regardless of what the market is doing. For example, you might decide to invest $500 into an S&P 500 index fund on the first of every single month. That's it. It's that simple. The beauty of this approach is that it automates your investing and completely removes emotion from the buying process. You're not trying to be a hero and catch the market at its lowest point. Instead, you're systematically buying in over time. When the market is down and prices are low, your fixed dollar amount buys you more shares. When the market is up and prices are high, that same fixed amount buys you fewer shares. Over the long run, this process averages out your purchase price, meaning you're less likely to have bought all your shares at an unfortunate market peak. It smooths out the bumps in the road. This strategy is particularly powerful for investors who are building their portfolios over time, like anyone contributing to a 401k or another retirement plan with every paycheck. You're naturally dollar cost averaging without even thinking about it. Every 2 weeks, a portion of your salary goes into your chosen funds, buying shares at whatever the current price may be. This disciplined, consistent approach prevents you from making one of the biggest investing mistakes, sitting on the sidelines with cash, waiting for a perfect entry point that may never arrive. With DCA, your money is always working for you. Furthermore, dollar cost averaging instills a crucial habit of consistent saving and investing. It turns investing from a one-time, high-stakes decision into a routine, manageable activity, much like paying a monthly bill. This consistency is the bedrock of long-term wealth creation. You are building your portfolio brick by brick, month by month, year by year. It might not feel as exciting as making a single massive bet on a stock, but it's a far more reliable and stress-free path to achieving your financial goals. It puts your investment plan on autopilot and lets you get on with your life. One of the most brilliant aspects of dollar cost averaging is how it changes your relationship with market volatility. For most investors, a market downturn is a source of panic and fear. They see the value of their portfolio dropping, and their first instinct is to sell to stop the bleeding. But for a DCA investor, a market dip is actually an opportunity. It's a sale. When the market goes down, you know that your next scheduled investment is going to buy you more shares of your chosen asset at a discount. You're essentially getting more for your money, which can significantly enhance your returns when the market eventually recovers. This psychological shift is a complete game changer. Instead of dreading downturns, you start to see them as a necessary part of the long-term journey and a chance to lower your average cost per share. This perspective helps you stay the course and continue investing when others are panicking. History has shown time and time again that markets recover from every single downturn, and those who had the discipline to keep buying during the tough times are the ones who are rewarded most handsomely in the long run. DCA forces you to buy low without even having to think about it. Let's consider a practical example. Imagine you're investing $100 every month. In the first month, the share price is $10, so you buy 10 shares. The next month, the market dips and the price drops to $5. Your $100 now buys you 20 shares. In the third month, the price recovers to $10. Your $100 buys 10 shares again. Over 3 months, you've invested $300 and acquired 40 shares, making your average cost per share just $7.50. Even though the price ended where it started, your investment is already profitable because you took advantage of the dip. This is the mathematical power of DCA at work. Ultimately, dollar cost averaging is a strategy that embraces imperfection. It acknowledges that we cannot predict the future and provides a systematic way to invest in the face of uncertainty. It's a humble approach that favors consistency over clairvoyance. By committing to a regular investment schedule, you reduce risk, average your purchase price, and turn market volatility from an enemy into an ally. It's an ideal strategy for any long-term investor who wants to build wealth methodically and without the stress of trying to time the market's unpredictable swings. All right, let's talk about one of the biggest, most catastrophic mistakes that new investors make, and honestly, even some experienced ones fall into this trap. It's the classic all your eggs in one basket scenario. Imagine you've done your research, you've found what you think is the next big thing. Maybe it's a hot tech stock or a revolutionary crypto project, and you decide to go all in. You pour every last cent of your investment capital into this one single asset. For a while, it might feel incredible. You see the price go up, your portfolio value skyrockets, and you start mentally spending all that future profit. But then, inevitably, something goes wrong. It's not a matter of if, but when. The problem with this approach is that you're exposing yourself to what's called unsystematic risk or specific risk. This is the risk tied to a single company, a single industry, or a single asset class. Maybe the CEO makes a terrible decision, or a new competitor comes out of nowhere and completely disrupts their business model. Perhaps a new regulation gets passed that cripples their entire industry overnight. Suddenly that stock you bet the farm on plummets, and because your entire portfolio was tied to it, your net worth gets absolutely decimated. It's a gut-wrenching feeling, and it's a completely avoidable disaster that wipes out countless investors who thought they had a sure thing. This is precisely why diversification is not just some fancy financial jargon. It is the fundamental safety net for every single intelligent long-term investor. Think of it like building a house. You wouldn't build a house with just one single support beam, right? Of course not. You'd use multiple beams, a strong foundation, and a variety of materials to ensure that if one part fails, the entire structure doesn't come crashing down. Your investment portfolio is exactly the same. By spreading your investments across different assets, you are building a robust financial structure that can withstand unexpected shocks and turbulence in any single area of the market. It's about survival first and then growth. So when we say don't put all your eggs in one basket, what we're really saying is don't take on unnecessary, uncompensated risk. The market doesn't reward you for taking the gamble of betting on a single stock. It rewards you for taking on broad market risk over the long term. By diversifying, you are essentially smoothing out the ride. When one part of your portfolio is having a bad month, another part might be doing exceptionally well, and that balance is what protects your capital and allows you to sleep soundly at night without constantly worrying that one piece of bad news could wipe you out completely. It's the responsible, smart way to build lasting wealth. Okay, so we all agree that diversification is crucial, but what does that actually look like in practice? It's more than just buying 20 different tech stocks. That's not real diversification. That's just concentrating your risk within a single, highly correlated sector. True diversification means spreading your investments across different asset classes that behave differently under various economic conditions. This means you should have a mix of stocks, which provide long-term growth potential, and bonds, which typically offer more stability and income, acting as a cushion when the stock market gets volatile. It's the classic yin and yang of a balanced portfolio. Beyond just stocks and bonds, you can diversify even further. Consider adding real estate to your portfolio, perhaps through real estate investment trusts or REITs. This gives you exposure to the property market without the headache of being a landlord. You can also look at international stocks, both from developed markets like Europe and Japan, and emerging markets like Brazil or India. This protects you from a downturn that might only affect the U.S. economy. By owning a piece of global commerce, you're ensuring that your growth isn't tied to the fate of a single country's economic cycle. The goal is to own a variety of assets that don't all move in the same direction at the same time. Within each of these asset classes, you need to diversify as well. For your stock allocation, don't just buy large-cap growth stocks. You should also own mid-cap and small-cap companies which can offer higher growth potential, albeit with more risk. You should also have a mix of growth stocks and value stocks. Growth stocks are companies expected to grow faster than the market, while value stocks are companies that appear to be trading for less than their intrinsic worth. By owning a blend, you ensure you're covered no matter which style is currently in favor with the market, preventing you from missing out on major trends. Ultimately, building a diversified portfolio is about creating a team of investments where each player has a specific role. Your stocks are your star strikers, scoring the points for growth. Your bonds are your steady defenders, protecting your capital when the other team goes on the attack. Your international stocks and real estate are your versatile midfielders, covering different parts of the field and adding another layer of strategic depth. By assembling this well-rounded team, you significantly reduce the chance that a single bad player or a single bad day for the market can make you lose the entire game. It's your financial safety net, and it's non-negotiable. Let's be brutally honest for a second. Do you really have the time, the expertise, and the emotional discipline to become a professional stock picker? For the vast majority of people, the answer is a resounding no. Picking individual stocks is incredibly difficult. It requires countless hours of research, reading dense financial reports, analyzing competitive landscapes, and trying to predict the future, which, spoiler alert, is impossible. You're not just competing against other retail investors. You're competing against armies of Wall Street analysts with PhDs, sophisticated algorithms, and access to information you could only dream of. It's like trying to win a Formula One race with a go-kart. The data on this is overwhelmingly clear. Year after year, studies show that the vast majority of professional, active fund managers fail to beat their benchmark index over the long term. According to the SPIVA report, over a 15-year period, more than 92% of large-cap U.S. fund managers underperform the S&P 500. Let that sink in. These are the supposed experts, and 9 out of 10 of them would have delivered better returns if they had just bought a simple, boring index fund and done absolutely nothing. So if the pros can't do it, what makes us think we can? The other killer here is fees. Actively managed funds charge exorbitant fees for their so-called expertise. You'll often see expense ratios of 1%, 1.5%, or even higher. That might not sound like a lot, but over decades of investing, those fees act like a ball and chain on your returns, compounding against you and siphoning away hundreds of thousands of dollars from your retirement nest egg. It's a silent portfolio killer. You're paying a massive premium for a service that, statistically speaking, is almost guaranteed to give you worse results. It makes absolutely no financial sense whatsoever. It's like paying for a first-class ticket and being forced to sit in the cargo hold. This is why trying to be the next Warren Buffett is, for most of us, a losing game. It's a strategy that's fraught with risk, high costs, and a very low probability of success. You might get lucky once or twice, but consistently beating the market over a lifetime is a near impossible task. It requires an immense amount of effort for a result that is likely to be worse than if you had taken the simplest path available. The good news is, you don't have to play this rigged game. There is a much simpler, cheaper, and more effective way to invest that has historically proven to be the superior strategy for the average person. So if picking individual stocks is a bad idea, what's the alternative? The answer is beautifully simple. Buy the entire market. You can do this through low-cost index funds and exchange-traded funds, or ETFs. An index fund is a type of mutual fund or ETF with a portfolio constructed to match or track the components of a financial market index, like the S&P 500. Instead of trying to pick the winners and avoid the losers, you just buy a tiny piece of every company in the index. You are guaranteed to get the market's average return, which, as we just saw, is better than what most of the highly paid professionals can achieve. The beauty of this strategy lies in its simplicity and its incredibly low cost. Because these funds are passively managed, the fees are microscopic. You can buy an S&P 500 index fund with an expense ratio as low as 0.03%. Compare that to the 1 or 2% charged by active funds. That difference means tens or even hundreds of thousands of additional dollars in your pocket come retirement. You get instant diversification, owning hundreds or even thousands of stocks in a single purchase, and you get it for next to nothing. It's the closest thing to a free lunch in investing. Think about what this means. By owning an index fund like one that tracks the S&P 500, you are a part owner of 500 of the largest and most successful companies in America. You own a piece of Apple, Microsoft, Amazon, Google, and hundreds of others. When American business as a whole does well, so do you. You don't have to worry about one company going bankrupt because its impact on your overall portfolio will be minuscule. You are betting on the long-term growth and innovation of the entire economy, which has historically been one of the safest and most profitable bets you can make. It's a strategy of humility and common sense. So for anyone starting out, or for anyone who wants to simplify their financial life and improve their returns, the path is clear. Forget the stock tips from your cousin, ignore the talking heads on TV predicting the next big thing, and just buy the haystack instead of searching for the needle. A simple portfolio of a few low-cost, broadly diversified index funds, like a total U.S. stock market fund, a total international stock market fund, and a total bond market fund, is all you need to build significant wealth over the long haul. It's boring, it's simple, and it is devastatingly effective. Albert Einstein reportedly called compound interest the eighth wonder of the world, saying, "He who understands it earns it, he who doesn't pays it," and nowhere is this incredible power more evident than when you reinvest your dividends. So, what is a dividend? It's simply a portion of a company's profits that it decides to pay out to its shareholders as a reward for owning their stock. You can take this payment as cash and go buy a cup of coffee, or you can do something infinitely more powerful with it. You can automatically reinvest it to buy more shares of that same company or fund. This might seem like a small, insignificant action at first. Maybe you get a dividend payment of $10. Reinvesting that buys you a fraction of another share. Big deal, right? Wrong. This is where the magic of compounding kicks in. That new fraction of a share you just bought will now also be eligible to earn its own dividends in the next quarter. So next time, your dividend payment will be slightly larger. You reinvest that, buying an even bigger fraction of a share, which in turn earns an even larger dividend. It creates a snowball effect that starts small but grows exponentially over time. Think of it like this. You plant a single apple tree. That tree grows and produces apples. Instead of eating all the apples, you take the seeds from those apples and plant more trees. Now you have a small orchard. Those new trees also produce apples, and you use their seeds to plant even more trees. Before you know it, you have a vast, sprawling orchard, and you're harvesting exponentially more apples than you ever could have from that single initial tree. Reinvesting your dividends is the financial equivalent of planting those seeds. You are letting your money work for you, and then letting the money that your money made also work for you. This process, known as a DRIP or dividend reinvestment plan, is one of the most powerful and passive ways to accelerate your wealth creation. Over a long investment horizon of 20, 30, or 40 years, the portion of your total returns that comes from reinvested dividends can be absolutely staggering. In fact, for many long-term market indexes like the S&P 500, reinvested dividends have historically accounted for over 40% of the total return. By not reinvesting them, you are willingly leaving a huge chunk of your potential growth on the table. You are turning off the engine of compounding. The best part about this incredibly powerful strategy is that it's ridiculously easy to implement. In fact, you can put it on complete autopilot. When you open a brokerage account with any major firm like Fidelity, Vanguard, or Charles Schwab, there's a simple checkbox you can tick for each of your investments. It will ask if you want to reinvest dividends and capital gains. All you have to do is check yes. That's it. From that moment on, every time one of your stocks or funds pays a dividend, the brokerage will automatically use that cash to purchase more shares for you without you having to lift a finger or pay any transaction fees. This automatic process does more than just build your wealth faster. It also reinforces positive investing habits. Firstly, it forces you to be a long-term investor. By automatically buying more shares, it encourages a set-it-and-forget-it mentality, preventing you from tinkering with your portfolio. Secondly, it takes advantage of dollar-cost averaging. When the market is down and share prices are low, your fixed dividend payment buys more shares. When the market is up and prices are high, it buys fewer shares. This ensures you are automatically buying more when assets are cheap, which is exactly what a smart investor should be doing. Let's look at a concrete example to see just how massive the impact is. Imagine you invest $10,000 into a fund that returns an average of 8% per year, with 2% of that return coming from dividends. If you take the dividends as cash each year, after 30 years, your initial $10,000 would grow to about $68,000. Not bad, but if you had checked that little box to reinvest the dividends, your total return would be the full 8%. In that case, your initial $10,000 would grow to over $100,000. That's a difference of more than $32,000, all from one simple click of a button, thanks to the relentless power of compounding. So, the very first thing you should do after watching this video is to log into your brokerage account and make sure that for every single one of your long-term investments, you have dividends set to reinvest automatically. It is the single easiest and most effective action you can take to boost your long-term returns. It costs you nothing. It requires zero effort after the initial setup, and it puts the mathematical certainty of compounding to work for you 24/7. Not taking advantage of this is like knowingly turning down free money. Don't be that person. Let your money make more money, and let that money make even more money. All right, let's talk about one of my absolute favorite concepts, and honestly, one of the most powerful long-term investing strategies you can possibly use, investing in companies with what Warren Buffett famously calls an economic moat. Now, what exactly is a moat? Think of it like a medieval castle. A strong castle had a wide, deep moat around it to protect it from invaders. In the business world, an economic moat is a durable, long-term competitive advantage that protects a company from its rivals, allowing it to maintain its profitability and market share over many, many years. This isn't just about having a good product for a quarter or two. It's about having a structural advantage that is incredibly difficult for any competitor to overcome, no matter how much money they throw at the problem. It's what separates the good companies from the truly great generational wealth-building investments. These moats come in several different forms, and understanding them is the key to identifying these fortress-like businesses. One of the most common is the brand moat. Think about companies like Coca-Cola or Nike. Their brand recognition is so immense, so ingrained in our culture, that it creates a powerful psychological barrier for consumers. You don't just buy a soda, you buy a Coke. You don't just buy sneakers, you buy Nikes. This allows them to command premium prices and maintain customer loyalty even when cheaper alternatives are available. That brand equity was built over decades and cost billions to maintain, making it almost impossible for a new company to replicate that level of trust and instant recognition. It's an intangible asset that pays very, very tangible dividends. Another powerful moat is what's known as switching costs. This happens when it's just too much of a pain, too expensive, or too risky for a customer to switch from one company's product to another. Think about your bank or the software your entire company runs on, like Microsoft Windows or Adobe Creative Suite. Sure, another company could offer a slightly cheaper or better product, but the hassle of moving all your data, retraining yourself or your employees, and dealing with potential compatibility issues is so significant that you just stick with what you know. This creates an incredibly sticky customer base that provides a reliable, recurring stream of revenue for the company year after year, almost on autopilot. It's a beautiful business model, because it locks in customers for the long haul. Finally, there's the network effect moat. This is where a product or service becomes more valuable as more people use it. The classic examples are social media platforms like Facebook or professional networks like LinkedIn. The reason you're on Facebook is because all your friends and family are on Facebook. The reason recruiters use LinkedIn is because that's where all the job candidates are. This creates a self-reinforcing cycle that makes the leader in the space almost untouchable. A new social network could have better features, but it's useless without the users. Companies like Visa and MasterCard also have a massive network effect moat. Merchants accept them because all the customers have them, and customers have them because all the merchants accept them. It's a virtuous cycle of dominance. So, how do you actually find these companies with wide, deep moats? It starts with a shift in your mindset. Instead of just looking at last quarter's earnings report or a hot stock tip, quick reminder: if you're enjoying this, please like, subscribe, hit the notification bell, share the video, and check the links in the description for more helpful content. You need to start thinking like a business analyst. Ask yourself, if I were given a blank check with billions of dollars, could I realistically build a company to compete with this one? For a company like Google in search or Amazon in e-commerce logistics, the answer is a resounding no. The infrastructure, the data, the brand trust, and the network effects they have built are simply too vast to replicate. You have to look for businesses that have a clear, identifiable, and sustainable advantage that will likely still be in place 10, 20, or even 30 years from now. That's the true test of a moat. One of the best indicators of a strong moat is consistently high profitability and return on invested capital, or ROIC. Companies that are constantly fending off competitors have to slash prices, spend heavily on marketing, and innovate relentlessly just to stay afloat. This eats into their profit margins, but a company with a strong moat can often raise prices year after year without losing customers, and they don't have to spend as aggressively to defend their turf. This financial strength shows up on the balance sheet. Look for a long history of high gross margins, stable operating margins, and a healthy return on capital. These aren't just numbers on a page. They are the financial proof that the company's competitive advantage is real and durable over time. You should also pay close attention to what the company's management talks about. Do they focus on their long-term competitive advantages in their annual reports and investor calls, or are they constantly talking about short-term promotions and fighting off the latest competitor? Great leaders of moat-like companies like Warren Buffett at Berkshire Hathaway are obsessed with widening their company's moat every single day. They understand that their primary job is to protect and expand that competitive advantage. Reading through a decade of shareholder letters can give you incredible insight into whether a company is focused on building a fortress for the long term or just trying to survive the next battle. Their language and priorities will tell you everything you need to know about their strategy. Ultimately, investing in companies with moats is a strategy of patience and quality over quantity. You don't need to find dozens of these companies. In fact, finding just a handful of truly great businesses with impenetrable moats and holding them for the long term can be the foundation of a massively successful investment portfolio. It forces you to focus on the underlying business quality rather than the daily fluctuations of the stock market. It's about owning a piece of a truly exceptional dominant enterprise that is built to last. When you find one, the best strategy is often to buy a meaningful position and then simply sit back and let that moat do the hard work of protecting your investment and compounding your wealth for decades to come. All right, let's switch gears and talk about something that is, without a doubt, the closest thing you will ever get to a free lunch in investing. And no, I'm not talking about some high-risk crypto coin or a penny stock tip. I'm talking about something completely legal, endorsed by the government, and available to almost everyone using tax-advantaged accounts. I cannot stress this enough. If you are investing for the long term, like for retirement, and you are not maxing out these accounts first, you are voluntarily giving away a massive portion of your potential future wealth to the IRS. It's like running a race but insisting on starting 100 yards behind everyone else. It just doesn't make any financial sense, and it's one of the biggest mistakes I see new investors make. So what are these magical accounts? The most common ones you'll hear about are the 401k, which is typically offered by your employer, and the individual retirement arrangement, or IRA, which you can open on your own. There are two main flavors of these, traditional and Roth. With a traditional 401k, or IRA, you contribute pre-tax money. This means you get an immediate tax deduction today, which lowers your taxable income for the year. Your money then grows completely tax-deferred for decades. You only pay income tax when you withdraw the money in retirement. This is a huge advantage because it lets 100% of your investment and its earnings compound without the government taking a cut every single year. Then you have the Roth 401k and Roth IRA, which are, in my opinion, one of the most powerful wealth-building tools ever created. With a Roth, you contribute after-tax money, meaning you don't get an immediate tax break today. I know that sounds like a downside, but here's the incredible part. Your money grows completely, 100% tax-free, and when you withdraw it in retirement, all of it, your original contributions and all the decades of growth, is completely tax-free. Let me repeat that, tax-free. Imagine your account grows to $1 million. With a Roth, you can pull that entire million out without paying a single penny in taxes on that growth. It's an unbelievable deal offered by the government to encourage you to save. The difference this makes over the long term is staggering. Think about it. In a regular taxable brokerage account, every time you get a dividend or sell a stock for a profit, you have to pay capital gains tax. This creates a tax drag that slowly eats away at your returns year after year, reducing the power of compounding. But inside a 401k or an IRA, your investments are shielded from this. They can grow unhindered, allowing the snowball of compounding to get much, much bigger over time. Whether you choose the immediate tax break of a traditional account or the future tax-free growth of a Roth, you are giving yourself a massive, mathematically proven advantage over investing in a standard taxable account. It's a head start you absolutely have to take. So the strategy here is simple but incredibly effective. Before you put a single dollar into a regular brokerage account like Robinhood or Webull, your absolute first priority should be to contribute as much as you possibly can to your tax-advantaged retirement accounts. For a 401k, this is especially important if your employer offers a match. A company match is literally free money. A common offer is a dollar-for-dollar match up to, say, 5% of your salary. If you're not contributing at least enough to get the full match, you are turning down a 100% guaranteed return on your money. There is no other investment on planet Earth that offers that. It is the single best and easiest financial decision you can make. Once you've secured the full employer match, your next goal should be to max out your IRA. For 2024, the contribution limit is $7,000 if you're under 50. You can open an IRA at any major brokerage like Fidelity, Vanguard, or Charles Schwab in just a few minutes. The choice between a Roth and a traditional IRA often comes down to whether you think you'll be in a higher tax bracket now or in retirement. If you're young and your income is relatively low, a Roth IRA is often the better choice because you pay the taxes now while you're in a lower bracket and get to enjoy all that tax-free growth later when you're likely earning more. If you're in your peak earning years, a traditional IRA might make more sense to get the tax deduction now after maxing out your IRA, The next step is to go back to your 401k and contribute as much as you can up to the annual limit, which is a whopping $23,000 for 2024. I know these numbers can sound intimidating, but the goal is to work towards them over time. The key is to automate it. Set up your contributions to come directly out of your paycheck. This way, you never even see the money, so you're not tempted to spend it. It's the classic pay yourself first strategy, and it's the most reliable way to build wealth. By systematically funneling money into these accounts, you are building a powerful, tax-efficient engine for wealth creation that will work for you 24/7 for decades. Only after you have exhausted all of these tax-advantaged options should you then start investing in a standard taxable brokerage account. Think of the 401k and IRA as your foundational, core wealth-building vehicles. They are your non-negotiable first step. The tax savings are not a small bonus. They are a fundamental component of the strategy that can literally add hundreds of thousands, if not millions of dollars to your net worth over an investing lifetime. Don't let complexity be an excuse. Take an afternoon, set these accounts up, automate your contributions, and you will be putting yourself on a financial trajectory that is light years ahead of the average person. It's the smartest money move you can make. This next strategy might sound incredibly simple, almost too simple, but I promise you it is one of the hardest for investors to follow, and it's where most people go wrong. The strategy is this: stay focused on the long term and ignore the short-term noise. This means ignoring the scary headlines on the news, ignoring the daily ups and downs of the market, and ignoring the panic you feel when you see your portfolio value drop by 10 or 20%. If you have a solid investment plan based on the principles we've discussed, diversification, low-cost index funds, quality companies, then one of the most powerful things you can do to ensure its success is to simply leave it alone. The art of successful investing is often the art of doing nothing. The financial media is not your friend. Their business model is built on clicks, views, and engagement, and the best way to get that is by peddling fear and greed. Every single day, there's a new crisis or a new unprecedented event that is supposedly going to crash the market. You'll see headlines like "recession fears grow" or "this stock is about to plunge." It's designed to trigger an emotional response and make you act impulsively. But if you look at a chart of the S&P 500 over the last 100 years, you'll see it's a story of constant growth, punctuated by temporary periods of fear and decline. Every single crash, every correction, every bear market in history has eventually been followed by a new all-time high. The long-term trend is always up and to the right. This is because volatility is the price you pay for higher returns. The stock market is not a savings account. You should not expect it to go up in a straight line. There will be periods of gut-wrenching volatility. It's not a question of if, but when. The key is to reframe how you think about these downturns. Instead of seeing them as a disaster, you need to see them as an opportunity. When the market is down, it's like your favorite store is having a massive sale. The same great companies and index funds you were buying last month are now available at a 10, 20, or even 30% discount. The disciplined long-term investor continues to buy during these periods, knowing they are acquiring quality assets at bargain prices that will pay off handsomely in the future. The worst thing you can possibly do during a downturn is panic and sell. This is called capitulation, and it's how people destroy their wealth. They sell at the bottom, locking in their losses, and then they're too scared to get back in, so they miss the inevitable recovery. This emotional cycle of buying high out of greed and selling low out of fear is the number one reason why the average investor's returns are so much lower than the market's returns. Your long-term success will be determined far more by your behavior and your discipline during tough times than by your ability to pick the perfect stock. Staying the course when everyone else is panicking is your single greatest advantage. So, How do you actually build the psychological fortitude to stay focused on the long term? It starts before the storm hits. You need to have a written investment plan, often called an investment policy statement or IPS. This document should clearly outline your financial goals, your time horizon, and your risk tolerance. It should specify your target asset allocation. For example, 80% stocks and 20% bonds. Having this plan written down when you are calm and rational acts as a critical anchor during times of market turmoil. When you feel the panic setting in, you can go back to your plan and remind yourself why you made these decisions in the first place, preventing you from making a rash emotional mistake. Another incredibly powerful technique is to simply not look at your portfolio every day. I know this is hard in an age where you can check your balance on your phone in 5 seconds, but it's crucial. Constantly checking your portfolio is like weighing yourself every 5 minutes when you're on a diet. The small fluctuations will drive you crazy and won't tell you anything about your long-term progress. Maybe you commit to only checking your accounts once a month or even once a quarter. The less you look, the less you'll be tempted to tinker, and the easier it will be to stay focused on the decades-long journey you're on, rather than the meaningless noise of a single trading day. Out of sight, out of mind, out of trouble. It's also helpful to study market history. Go back and read about the dot-com bust of 2000, the financial crisis of 2008, or the sharp pandemic crash of 2020. In the moment, each of these events felt like the end of the world. People were absolutely convinced that this time is different and that the market would never recover. And yet every single time it did. Understanding that severe downturns are a normal, recurring feature of the market landscape can help to desensitize you to the fear when the next one arrives. When you see the market plunging, instead of thinking this is unprecedented, you can think, I've seen this movie before, and I know how it ends for patient investors. Ultimately, staying focused on the long term is about having deep-seated conviction in the engine of capitalism. You are betting that over the long run, human ingenuity, innovation, and the desire for progress will continue to drive corporate profits and economic growth. This has been a winning bet for over 200 years, and there's no reason to believe it will stop now. Your job as an investor is not to predict the next recession or time the next market dip. Your job is to lash yourself to this powerful, long-term engine of growth by owning a diversified portfolio of the world's best businesses, and then have the patience and discipline to hold on through the inevitable turbulence. If you can do that, your financial success is all but guaranteed. All right, let's get into our 9th strategy, and this one is absolutely critical for long-term success, but so many people just completely forget about it. I'm talking about rebalancing your portfolio. Now, what does that even mean? Think of it like this. When you first start investing, you decide on a specific mix of assets. Maybe you say, I want 70% in stocks and 30% in bonds. You set it up perfectly, everything is balanced, and you feel great. But over time, the market does its thing. Your stocks might have an incredible year and grow much faster than your bonds. Suddenly, without you doing anything, your portfolio might be 85% stocks and only 15% bonds. You've drifted away from your original plan, and that's a problem. The reason this drift is a problem is all about managing risk. Your initial allocation, that 70-30 split, wasn't just a random number you picked out of a hat. It was based on your personal risk tolerance, your financial goals, and how much volatility you're comfortable with. When your portfolio becomes overweight in stocks, you're taking on significantly more risk than you originally intended. A sudden market downturn could hit you much harder than you planned for. Rebalancing is simply the process of bringing your portfolio back to its original intended asset allocation. It's like a regular tune-up for your investments, making sure everything is running exactly as it should be according to your master plan. So how do you actually do it? It's surprisingly simple. The most common method is to sell some of your overweight assets. In our example, you'd sell some of those high-flying stocks and use the proceeds to buy more of your underweight assets, in this case the bonds. This forces you to follow one of the golden rules of investing: buy low and sell high. You're systematically trimming your winners after they've had a good run and buying more of the assets that haven't performed as well, all while keeping your risk level in check. It's a disciplined, unemotional way to manage your portfolio, taking the guesswork and the FOMO completely out of the equation. Now you might be thinking, Graham, wait a second. Why would I sell my best performing assets? That sounds completely counterintuitive. And I get it, it feels weird to sell the things that are making you money. But that's the beauty of this strategy. It forces you to lock in some of your gains and prevents you from becoming too concentrated in one area. Markets are cyclical. What goes up can, and often does, come down. By rebalancing, you're not just managing risk, you're also positioning yourself to capture gains from the next asset class that's due for a run-up. It's a disciplined approach that keeps your long-term strategy on the rails, no matter what the market is doing. Okay, so you're sold on the idea of rebalancing, but the big question is, how often should you actually do it? There are two main schools of thought here, and honestly, both of them work just fine. The first is calendar-based rebalancing. This is the simplest method. You just pick a date on the calendar and stick to it. Maybe it's once a year on your birthday, or every 6 months on January 1st and July 1st. The key is consistency. This approach is great because it's easy to remember, it's systematic, and it prevents you from obsessively checking your portfolio every single day, which is a recipe for emotional decision making and, let's be honest, a lot of unnecessary stress. The second approach is what's called percentage-based or threshold rebalancing. Instead of relying on the calendar, you set specific percentage triggers for your asset classes. For example, you might decide to rebalance anytime your stock allocation drifts more than 5% away from your target. So if your target is 70% stocks, you would only take action if it goes above 75% or falls below 65%. This method can be a bit more hands-on, as you need to monitor your portfolio more closely, but it ensures you're only making moves when they're truly necessary, potentially saving you on transaction costs and taxes if you're investing in a taxable brokerage account. Now let's talk about where you rebalance, because this can have a huge impact on your tax bill. If you're doing this inside a tax-advantaged account like a 401k or a Roth IRA, it's a piece of cake. You can sell your appreciated assets and buy others without triggering any capital gains taxes. It's completely tax-free. This is, without a doubt, the best place to rebalance your portfolio. You can shift things around as much as you need to without having to worry about sending a check to the IRS every time you sell a winner. It gives you incredible flexibility to maintain your desired allocation without any tax friction whatsoever. But what if you need to rebalance in a regular taxable brokerage account? You have to be a little smarter about it. Selling assets that have gone up in value will create a taxable event, capital gains tax. One way to minimize this is to use new money to rebalance. Instead of selling stocks, you could simply direct all your new investment contributions towards your underweight asset class, in our example bonds, until the portfolio comes back into balance. This way, you're not selling anything and not creating a tax liability. It might take a little longer, but it can be a much more tax-efficient way to keep your long-term plan on track. And for our 10th and final strategy, let's talk about something exciting: investing in innovation. This is where you hear about things like artificial intelligence, green energy, biotech, cryptocurrencies, and all the other groundbreaking trends that promise to change the world and make early investors an absolute fortune. And let's be real, it's tempting. The stories of people who bought into Amazon or Tesla in the early days are legendary. The potential for explosive growth is undeniable. And allocating a small part of your portfolio to these high growth areas can supercharge your returns over the long term if, and this is a big if, you do it correctly. The danger, however, is just as significant as the potential reward. For every Amazon, there are thousands of failed .coms that went to zero. For every Tesla, there are dozens of electric vehicle startups that burned through all their cash and disappeared. These innovative sectors are characterized by extreme volatility, hype, and uncertainty. It's incredibly difficult to pick the long-term winners from the short-term fads. People get caught up in the story, they get a serious case of FOMO, fear of missing out, and they end up throwing way too much money at an unproven idea, which can be devastating for their financial future. This is why the key word in this strategy is wisely. Investing in innovation should not be your core strategy. It's the satellite, not the planet. Think of it as the speculative, high-risk, high-reward slice of your overall portfolio pie. Your foundation should always be built on proven, diversified strategies, like broad market index funds and blue chip stocks. Those provide the slow, steady, reliable growth that will build the bulk of your wealth over time. The innovation part is the extra spice you add on top, not the main course of the meal. The first rule of investing in innovation is to strictly limit your exposure. Financial advisors often recommend allocating no more than 5 to 10% of your total portfolio to these speculative investments. This is your play money, so to speak, but with the potential for serious returns. By capping your allocation, you protect yourself from catastrophic losses. If your big bet on AI-powered cat toys goes to zero, it's disappointing, but it won't derail your entire retirement plan. But if it does hit, that 5% could grow into a much larger piece of your portfolio. So you've decided to allocate a small percentage to innovation. How do you actually do it? You could try to pick individual stocks, but that's extremely difficult and risky. A much smarter approach is to invest through specialized ETFs. There are ETFs that focus on artificial intelligence, renewable energy, genomics, cybersecurity, or robotics. For a relatively low fee, you get instant diversification across dozens or hundreds of companies within that theme. This way, you're not betting on just one company to succeed. Using a thematic ETF spreads your risk. If one company in the fund fails, it won't sink your entire investment. Instead, you're betting on the growth of the sector as a whole. For example, instead of picking which company will win the AI race, you can buy an AI-focused ETF and get exposure to established giants like Nvidia and Microsoft to smaller up-and-coming players. This is much more prudent than taking single stock risk. Another critical point is to do your homework. Just because an ETF has a cool theme doesn't mean it's a good investment. You need to look under the hood. What are the top holdings in the fund? Are they companies with genuine long-term competitive advantage or just flavor of the month hype stocks? You also need to pay attention to the expense ratio. The fees on specialized ETFs are almost always higher than a simple S&P 500 index fund. Make sure the fee is reasonable, because high fees can eat away at your returns over the long run. And finally, you have to be prepared for a wild ride and have a long-term mindset. These innovative sectors are going to be incredibly volatile. There will be massive swings up and massive swings down. You cannot panic sell when the theme goes out of favor, because it will. These are 10, 20, or 30-year bets on the future. You have to buy and hold through gut-wrenching downturns to be there for the potential explosive growth. If you don't have the stomach for that volatility, it's better to stick with broader market index funds and avoid this part of the market altogether. And there you have it. That's it. 10 powerful, proven long-term investing strategies that actually work. From the simple but effective buy and hold approach and the automated discipline of dollar cost averaging to the risk managing power of diversification and rebalancing. We've covered why low-cost index funds are a secret weapon for most investors, how reinvesting your dividends unleashes the magic of compounding, and the importance of using tax-advantaged accounts to give yourself a massive head start. These aren't get-rich-quick schemes. They are the fundamental principles that have built fortunes for patient, disciplined investors for decades. The truth is, successful investing isn't about finding some secret stock tip or perfectly timing the market. It's about behavior and consistency. It's about creating a simple, solid plan based on these principles and then having the discipline to stick with it year after year through good times and bad. The market will go up and it will go down. There will be moments of euphoria and moments of panic. The headlines will scream at you to buy or sell. The real secret to winning this game is to ignore all that noise, stay consistent, stay disciplined, and let time do the heavy lifting for you. Your financial future is in your hands, and it starts with the decisions you make today. You don't need a finance degree or a six-figure salary to start building serious wealth. All you need is a plan and the commitment to see it through. Every dollar you invest today is a seed you're planting for your future self. By applying these 10 strategies, you are giving those seeds the best possible environment to grow into a massive financial forest over time. The power isn't in any single strategy, but in how they work together to build a robust, resilient portfolio that can weather any storm. So I really hope you found this helpful. If you got any value out of this video, do me a huge favor and smash that like button for the YouTube algorithm. It really does help the channel out. Make sure you subscribe for more smart money tips just like this, and I want to hear from you down in the comments. Let me know which one of these strategies are you already using, or which one are you planning to start implementing right away. Thank you so much for watching, and as always, I will see you in the next video. Before you go, make sure to like, subscribe, hit the notification bell, share this video, and check the links in the description for more ways to grow your wealth. Before you go, grab your copy of the Kindle book, Get Rich by Investing by Craig Smith, CEO of CRAIGTRADER Companies and a longtime experienced investor with a finance degree. This book can help any level of investor become better and more professional. The link to get it is the first link in the description. Thanks for your support.